Hello friends, subscribers, my wife and Tom from work. It's that time of the quarter where investors provide us with their 13 F's, their 13 F's, where the world's greatest money managers and investors show us exactly what not to do.
Don't do anything I would do, and definitely don't do anything I wouldn't do. There's a little gray area in there, and that's where you operate.
Bill Ackman keeps buying Nike, great shoes, but has he ever worn a pair of Nikes? And has he ever stepped inside of a Foot Locker? Does he know what competition is? Buffett sold out of Ulta Beauty after one quarter and bought some Domino's. Next quarter we'll be reporting how he's out of that one. Burry is still a communist, and the FinFluential undervalued portfolio is up 50% year to date. No additions this quarter because I don't flip-flop like a fish. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks sank on Friday to track steep weekly losses as investors absorbed Jerome Powell's words that signaled the Fed won't be in a hurry to make interest rate cuts, as well as Donald Trump's cabinet and his economic policies. The selling today was led by healthcare, technology, semiconductors, the big names, Nvidia, Microsoft, Apple, Google, Meta. Tesla did buck the trend, and there was some tailwinds for the car manufacturer. And then the outperformers here today was simply just utilities and financial stocks. However, when we have something like the Nasdaq 100 and the S&P 500 fall 1.3% and 2.24%, the market as a whole is going to be very, very red. If you were in broad market-based indices today, it was a very, very brutal day. However, there were some standouts. Tesla was up 3% today, and that's because Donald Trump is contemplating canceling the $7,500 EV tax credit. Now, this is drawing industry pushback. Major EV and battery manufacturers are arguing that removing the tax credit would hurt economic growth and the overall industry, making EVs less affordable for consumers. Despite the potential negative impacts on the broader EV market, Tesla shares rose, and that's because analysts see this as a long-term tailwind for Tesla thanks to its unmatched scale and competitive advantage. Even as demand may soften, Tesla will be the winner out of all of this, and that's why it was up 3%. Palantir was up double digits today, and that's because it's simply moving its listing from the New York Stock Exchange to the Nasdaq exchange, and this would make it eligible to join the Nasdaq 100. And we also saw healthcare stocks, Pfizer, and a whole bunch of other names fall in excess of 4%, and that's because Donald Trump elected Robert F. Kennedy Jr. as the Secretary of Health and Human Services, and he's been outspoken on health, vaccines, and a whole bunch of other issues that don't bode too well for these healthcare companies. And then looking at the broader market, we saw the worst performing sectors, right? Technology, XLK, XLC, and then healthcare, XLV, with the S&P 500 falling 1.3%, a brutal day across the board. I mean, utilities, financials, real estate, they were the only green, but they were not enough to lift the whole market. I mean, financials is a huge sector, but when you have tech, XLC, healthcare down in the dumps, as well as energy, industrials, materials, staples, yeah, it's going to be a very ugly day. And it wasn't just large cap, guys. It was small caps, mid caps. Mid caps did outperform on a broad base, but really it was red across the board, particularly here in growth. Small cap growth down 1.6%, large cap growth as well as large cap core down 1.3 and 2.5% respectively. A very ugly day in the market, and this is on the back of better than expected economic data. And pretty much, guys, the Fed came out and said yesterday, Jerome Powell came out and said yesterday that because of the strong economic data they're seeing, they're going to take their time with cutting rates. Now, I believe that's a good thing because stronger economic data and slower rate cutting cycles is generally good for equities longer term. However, in the here and now, the market is reacting really adversely to that, and retail sales sort of put fuel on the fire to that narrative because retail sales came in better than expected. The market was expecting 0.3, we got 0.4%, and we also saw a September revision from the 0.4% to 0.8% mark. As a result of this data, the market was now only pricing in a 62% 50% chance of a 25 basis point rate cut in December. At the start of the week, we were looking at an 81% chance of a rate cut in December. So we are seeing rate cut expectations being pared back, and the market is reacting to that accordingly, along with all of Donald Trump's policies that come with as a result. However, if we do look at market breadth, 5-day moving average still looking disastrous. However, medium term, longer term trends look intact. However, if we do see selling on Monday, we will lose the 20-day and potentially the 50-day moving average. But longer term trends, guys, if we look at it in the year and now, it remains solid and looks very, very solid, all things considered. But let's hop on the charts. And across the board today, it was red. I mean, equities, large caps, mid caps, small caps all fell, but it wasn't just equities. Yields did rise, but the dollar fell as well. Bonds fell, commodities fell. A brutal day. If you were just invested in risk assets, it wasn't a good day for your portfolios. And what we also saw looking at the S&P 500 was we continued the daily downtrend from the core resistance. And this is something we spoke about. We said once we hit the core resistance and it doesn't move up, what we normally see is actually a pullback, asymmetrical downside. And that's actually what we're seeing right now. So what we're seeing is not completely unexpected. This happens when we get to the core resistance and we don't see it move up. But for the S&P 500, we are still in positive gamma. However, if we do open lower on Monday, we can actually see put support become our target zone simply because we'll be in negative gamma. However, for the Nasdaq 100, we are already in negative gamma. As you can see right here, there is a little bit of downside left to get to the put support, but we did see a little bit of front running in excess of that. Nonetheless, we are in negative gamma, and that means the target is 20,200. But already having brought forward a lot of the move, what we could actually see in the Nasdaq 100 is a move up to the gamma flip to start the week off right, and then we will make the next move. If that's upside or downside back to the put support, we'll have to see. And we have a very similar situation in the RTY, which is pretty much at the put support. I think early in the week, we see a little bit of reprieve to the gamma flip depending on where it moves, and then we make the next move to the upside, or if we actually use the gamma flip as resistance and continue the churn we've seen in the last couple of weeks. Nonetheless, guys, we are in a daily downtrend. We are in negative gamma, and that means if the put support moves down, we then target those lower levels, and this does mean we are in a heightened time of volatility, especially going into November's OPEX. Nonetheless, I do see this as an overall just an opportunity for us to get long. I still think there's a ton of tailwinds from buybacks to seasonality to take us higher into the end of the year. We're just seeing a little bit of churn. The market rose too much, too fast, and now we're sort of just paring that back. A little bit of consolidation here, and then a move higher into the end of the year will be good. If you want to talk about material downside, I think we see a 10 to 15% decline in between January and February at the start of 2025. I think material downside will come around then. Don't think it's going to happen just yet. I think we will finish the year higher than where we are right now in the Russell 2000, as well as the S&P 500 and the Nasdaq 100. And all in all, guys, when you look at the year-to-date chart, things look very, very constructive for all of these indices, the RSP, the S&P 500, and all we're seeing is a re-rating of growth and market expectations. And that leaves us in the camp to buy the S&P 500 right here or at the put support and really just get long in the Nasdaq 100 and the Russell 2000. Maybe the RSP, we could see a little bit more of a pullback. I would love to get a pullback to the 176 area. I would actually be a buyer there. Seems a bit of a long way to go. Nonetheless, guys, buy any dips we do get. We want to buy the fear, not sell it, because we will be going higher into the end of the year. Real downside only comes next year, and I'll keep you guys informed. So go ahead, subscribe so you don't miss a beat and you don't miss everything that's to come in the next couple of months, this Christmas period, and for 2025. And diving into sentiment, this is the IMI Global Survey, the near-term market outlook based on sentiment and risk appetite. And in November, US equity investors' risk appetite surged to its highest level, reflecting a significant shift in sentiment as political uncertainties eased and the US macro outlook improved. And that's why we saw a huge uptick in risk appetite as well as sentiment. And this comes on the back of what is the most bullish month in the year, November. We normally see, guys, a huge uptick in the very first couple of days in November and then a digestion period. And this is where we are right now. And like I said in yesterday's video, seasonality is just a whole bunch of years condensed into a single line. But when you actually extrapolate it in the year to year, you get a lot of noise. And that is what we're seeing right now in the market. A lot of upward momentum, a lot of downward momentum, but you do have to understand that all of this is seasonally normal digestion that we do get in this November period. But what we normally do is put in a low and then rip up from there with an average return of just above 1.8% for the month of November. And looking at the year in total, guys, so far for this year, the annualized returns per day, Friday has been the best returns, seeing 43% gain so far for this year, annualized in the S&P 500, and pretty much the worst day being Tuesday. So what we normally see is we get a good start on Monday, a little dippier Tuesday, and then a real rally into the end of the week. That has been the daily seasonal trend in annualized returns per day for the S&P 500. And looking at the market's earnings picture, this is very interesting data we have from Goldman Sachs. Now, this is what they believe. This is the market consensus, and pretty much what Goldman Sachs believe we are to do over the next 12 months is 11% growth at $268 in earnings per share. In 2024, they see 8% growth, and that would leave us at a next 12-month PE of 21.6, and then on next year's earnings 21.3. So, and despite the market looking pricey, what Goldman expects us to do over the next couple of months is mild multiple contraction, and most of the rally to come from the earnings growth we should get in the next year. If we look at the consensus, we see much of the same multiple contraction, but slightly higher earnings growth, which means if Goldman is correct, we should see anywhere from 8 to 11% earnings growth and price appreciation in the S&P 500. If the consensus is correct, that number should be 13%. Either way, Goldman see higher earnings per share for the S&P 500, and normally price follows earnings very, very closely, meaning if these numbers are to materialize, expect anywhere from 10, 11% to 13% in S&P 500 returns in 2025. And diving into the macro, we got some more Goldman data right here, and this is GDP quarterly growth expectations 2024 and then into 2025. And guys, Goldman Sachs are expecting a significant boost in GDP despite the consensus estimates 2.6, 2.5, 2.2% all the way into 2025. And it's safe to say the consensus haven't re-rated yet for a Trump win. However, Goldman have sort of priced that in. I do think the truth is probably closer to Goldman's base case considering everything we're seeing in the market right now. And a Trump victory also means higher than expected real income growth, which should remain firm due to strong wage growth. And this is across the board in the US, UK, Canada, as well as the Euro area. And while we will see deceleration in real income growth and wage growth, it should remain above trend, particularly with CPI falling. And when you look at disposable income and employee compensation relative to inflation, you can see right here that since February 2020, inflation has increased 19%. This is the PCE index, whereas disposable personal income as well as employee compensation has increased 29% and 31% respectively. And this is one of the biggest reasons why there hasn't been a recession. However, there are some risks to this market. One of them is tariffs. And if we actually look at what happened between 2018 and 2019 when Trump imposed his trade war and tariffs, we saw core goods, the cost and prices of goods increase significantly in tariff impacted categories. And we will see much of the same if Trump's tariffs come to pass. So that is a risk to the overall market. Nonetheless, the fundamentals look good in the here and now. And we actually have a word here from Goldman regarding Trump's presidency. They expect the second Trump administration to bring higher China tariffs on autos, much lower immigration, some fresh tax cuts, and regulatory easing. If so, the US economy should grow 2.5% in 2025, outperforming consensus expectations expectations and other developed market economies for the third year in a row. The biggest risk is a large across-board tariff, which would likely hit growth very, very hard. So we'll see what comes to par, the higher growth or the tariff impacts. Nonetheless, there are still very clear risks to this market that we do need to be aware of, and then markets will price in very, very quickly. And that's why I'm keeping a close eye on tariffs and economic growth, because the second those things turn, it's time to get defensive. And diving into earnings next week, the big one, what everybody's going to be looking at is Nvidia. Now, the estimate here is for 75 cents in earnings and 33 billion in revenue. That is really going to move the market, particularly the tech space, the semi space. However, apart from Nvidia, there are a couple of market movers. Walmart has its earnings, Intuit, PDD, Lowe's, TJX, PanW, Palo Alto, as well as Medtronic's, Deere, Target Corporation, Copart. So still a very name-heavy week that can definitely move the market, particularly in the retail sector, the staple space, as well as technology. And then next week, we don't have much in terms of data. The big news is actually going to be on just housing data. We get building permits here on Tuesday, as well as housing starts year over year and month over month figures. We also have existing home sales on Thursday. That's really it. And then apart from initial jobless claims, the other big thing is going to be PMIs. We get those on Friday. Manufacturing services and composite PMIs, as well as UMISH sentiment. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.